So, excuse the mess in the background. We've still got a little bit of repair work that we're doing to the frame of the barn. So we've done a lot of it. We're replacing the tin. It's all going to get painted up, and then we'll remove the agri-props when we level off the floor. We've had some new wood and timber installed, and it should look great when it's finished. So let's talk about interest rates, and in particular I want to talk about a video that I saw on YouTube. It's a good channel, there's some great advice on there. However, this one video that I saw was actually terrible advice, and it's going to cost someone a lot of money. So the reason that I felt like I had to talk about this was because they had a customer, and they said, we're going to save you some money on your interest charges. You've got a £50,000 car loan, and you've also got a mortgage with a lot of equity in it, and we can move some money onto the mortgage. The mortgage rate is only 2%, the car finance is 8%. So great, going to save you some money. Or are we? We're not actually. We're going to cost that guy a huge sum of money, because £50,000 moved onto a 20-year term. He's probably going to end up paying something like £75,000, £80,000. I've not worked it out properly on a mortgage calculator, but believe me, he will pay back almost half again of what he's borrowing. He would be much better off leaving the car on the 8% over the short term and paying back probably £1,000 or a bit more, maybe £2,000 in interest. It is a £50,000 car. Again, I haven't worked out the figures accurately, but I know for a fact that moving a car loan at 8% over 3 or 5 years onto a 20-year loan is a disaster. It's going to cost him an absolute fortune. So unfortunately, it's terrible advice. Much better off leaving it. The reason is because the reason you're paying back so much more is because you're financing that vehicle over a very long period. If you look at the mortgage statement, you're paying back nearly half again of what you borrow, because it's 20 years. You're much better off borrowing money the shortest period possible. 8% or 2%, it doesn't matter. The term of the finance matters. So it's terrible advice. There's another side to this story, which is actually also bad news, and we're going to talk about that in just a second. So let's go back into the house. So back in my desk. So the other reason this is a very bad idea is, what do you think that customer is going to do once he realizes that he doesn't have car finance anymore, and doesn't really think that it's added onto his monthly mortgage payment, because he's only repaying something like £200 a month now instead of £900 a month? He's probably going to go, I can go and afford to buy a new car. My monthly payments have gone down. He goes out, buys another car. All he's done is just got himself another £50,000 further in debt against his mortgage. It's a really bad idea. Again, you should really have finance associated with the asset on a separate agreement. Otherwise, you don't know where things are, and you don't know what's going on. A bit like taking out a loan for a car and then getting rid of the car, but and then having the cash come in, then use it for something else, and have the loan payments still go out. You just lose control of your finances and lose control of where you need to be with your monthly budgets. So very bad idea. Overall, the message is, be very careful about what sort of finance you're taking out, and look at the term and look at the interest rate. Don't just look at the interest rate on its own. 2% over 20 years will cost you a hell of a lot more than 8% over 3 or 5 years. Check it out if you don't believe me. Any questions, please put them in the comments, and I'll come back to you. Thanks for watching, and hope to see you again.